Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to another episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, traders, money managers, brokers, strategists, authors, experts of any sort, with which we think have a compelling story to tell, some insights to share, and lessons learned that we can all benefit from. Today we have a fantastic author, money manager, someone who's had some fantastic experiences in the financial markets that I'm super excited for you to hear about. Victor Haghani. Victor is the founder and chief investment officer of Elm Wealth. As you'll learn from our conversation, he was one of the founding partners of Long-Term Capital Management. We had a really fun conversation about lessons learned from that pivotal moment in financial market history, but also his start at Salomon Brothers, working with John Merriweather and others, sort of those foundational experiences analyzing the fixed income markets, how some of those lessons learned along the way have shaped him into the investor he is now with Elm Wealth. We'll talk a lot about his book, The Missing Billionaires, A Guide to Better Financial Decisions. It is a fantastic part history lesson talking about key moments in history, how some of the wealthiest American families have not been able to keep that wealth going for multiple generations, and the number one reason why, in Victor's opinion, that's the case. We talked about those missing billionaires, and one of the key mistakes that they tend to make is with bet sizing and how concentrated their bets actually are. At the end of the day, it's about what we invest in and how we spend our money. And so we try to talk about both of those general themes. We focus a lot about the investing side, of course. Talked about a coin flipping experiment that Victor conducted years ago. Some of the lessons learned and what it taught him and his fellow researchers about risk management, about risk aversion, and how most investors tend to make decisions that are not in line with their true risk appetite. We talked about probabilistic thinking, which is an area we talk about a lot on my YouTube channel. We do a probabilistic analysis special every 6 to 8 weeks where we look at a major index and talk about different probabilities, different possibilities. So we talk about probabilistic thinking and why that can be so important. At the end of the day, Victor's expertise really is deep into statistical analysis of risk. It's into balancing and I think respecting potential risks versus potential returns. We think about talking about expected outcomes. It's a history lesson into what has happened during previous market cycles and what the experience of an investor can be over time. And it's all about behavioral finance. It's all about the challenges we have making good decisions. And I think in what you'll find from Victor's conversation, he and his team have developed some pretty effective ways to try to help us address some of those behavioral biases in our own investment process. So please enjoy this conversation with author, money manager, and investor Victor Haghani, founder and chief investment officer of Elm Wealth. So super excited to be sitting down with Victor Haghani. Victor, I really enjoyed your book, The Missing Billionaires. Excited to talk to you about the book and all other things market related. But first off, welcome to the show. Thanks for coming on.
Thank you so much, Dave. Thanks for having me. I hope it won't be the last time too.
I hope so too. We have a lot to talk about. Just before we hit record, we're talking about flying. We're talking about a lot of different things. So I think you and I have plenty to talk about. But again, congratulations on your book. I really enjoyed it, and I'm so glad that I was introduced to your work because it was a fantastic mix of a history lesson of investing, a great sort of overview of behavioral biases and why we make poor decisions, but a lot of practical tools to help people sort of, hopefully make better decisions. So I hope we can touch on each of those. But to start off with, the title of your book was just so powerful, The Missing Billionaire. So my first question, where are all the ultra wealthy Vanderbilts we would expect to see, given the incredible wealth that families like that had that should have turned into lots of billions by now? What happened?
Well, yeah, it's remarkable that we don't have more. We basically have virtually no very wealthy individuals today who can trace their wealth back to the beginning of the 20th century. And we should have, in some ways, we should have thousands of them, but we basically can hardly find even one. And it's our belief that this didn't come about because the last 125 years was a poor investment environment, or there was some financial cataclysm that just wiped everybody out. Quite to the contrary, it was an amazing investment environment in the U.S. and even in the Western world over the last 125 years. And so this puzzle really can only be explained in terms of the two main dials, the two main things that we have to think about financially, which is investing and spending, and well, saving
Mm,
too is part of that. Spending and saving are kind of two sides of the same coin, but investing and spending decisions. And we think it's very likely, and having looked at a few individual families to sort of check this hypothesis very casually, we think that, in general, a lot of these wealthy families took too much risk. Some of them took too little risk and kind of just kept their money in relatively safe bonds and government bonds that either didn't give a return or turned out to be less safe than anticipated. But generally, people took too much concentrated risk, keeping their investments in the kinds of things that made them rich to begin with, like the Vanderbilts keeping their money in transportation and railroads right to the end. Um,
mm.
and that combined with spending policies, which spending decisions that might have made sense in the moment, but they didn't adjust them as their wealth changed. And so people kind of locked in sometimes very high levels of spending, and spending levels that even got higher because of um, not just inflation, but all kinds of other increases in the standard of the cost of the maintaining a standard of living. And these sort of inflexible spending policies that people got, or spending patterns that some of these families got into, combined with taking too much risk, and then letting the clock run for many decades, that it doesn't happen all of a sudden, it happens kind of slowly. All of a sudden, the wealth was dissipated. And, it's just remarkable, that we don't have many, that there's not lots and lots that we would look at. We're not saying that there should be, in our book, we kind of make this, we say that, oh, there should be, I don't know, 16,000 of these billionaires. And of course,
Yeah.
you couldn't have that many, because then they would like own all of the money in the world. And, that couldn't have taken place. But like their total absence is such a signal about the difficulty of making sound financial decisions over many decades and lifetimes.
It's so fascinating, and I feel like it's a cautionary tale, and this is something I've always found challenging with the whole logic of the hedge fund community, right? You have a certain number of assets, and all of a sudden you're treated as someone who understands risk taking and how to allocate and things, when in reality those aren't guarantees, right? More zeros in your account don't necessarily mean you have improved understanding of how to make decisions. I'd love to talk a little bit, Victor. I mean, talk about your own experience within financial history. You were an early investor partner at Long Term Capital Management. Books have been written about the challenge and what happened and how that played out. You have some great personal anecdotes, which you shared in your book about your own experiences there. Could you just summarize, looking back at that experience? How did that change you? What surprised you about it, and how did that change your, I guess, the way that you think about investing after that experience?
Sure. So let me just put everything into a tiny bit of context. So I graduated from university studying finance and economics in 1984. I went to work at Salomon Brothers in New York, and in
Yeah.
their research department, and then was invited to join the trading desk, a trading desk out on the Salomon Brothers trading floor, run by John Merriweather at the time. And then about 10 years later, when John was starting the hedge fund Long Term Capital Management, I just got married. I left Salomon Brothers. I joined John and some of my other partners and colleagues from Salomon Brothers, and we started LTCM. And the idea of LTCM was to do what we had been doing at Salomon Brothers, which was fixed income relative value trading, looking at different bonds that had really similar cash flows, and sometimes their prices and yields were very different, and you could also find things that were a little bit more different, that even had more different pricing. And
Sure.
that was what we did at Solomon Brothers, and we were going to attempt to do this in a standalone pool, with a standalone pool of capital at LTCM. And things went much better than we ever anticipated at LTCM in the early years. And we made some, with hindsight, and even without hindsight, I think we made some suboptimal or poor decisions. Suboptimal, that's a funny word to use, for like mistake. Suboptimal. No, wasn't suboptimal. We made
It's
some.
much better. Suboptimal
Yeah, I'm
decisions. I
sorry
like that.
about that. Yeah, not suboptimal at all. Very suboptimal. And then in 1998, LTCM lost like 90% of what was then investors' capital. We had paid out a really big dividend back to most of our investors at the end of 1997. So our most of our investors actually did quite well because we paid such a big dividend. But we were kind of trying to take the hedge fund private over time. That we felt that
Yeah.
the opportunities were limited in scale, and that we couldn't just keep on growing our positions, that we thought that we needed to keep our positions relatively small. And we kind of hoped that we could make this transition to basically becoming like a trading firm ourselves, where we were
Mm.
just using partners' capital instead of outside capital. But
Yeah.
we didn't manage to make that. We didn't get over the chasm. In our case, the chasm got us in between, one state to the other.
Right.
And after LTCM, or shortly after that, I took about a 10-year sabbatical to, well, first to just spend time with my young family. But I really was questioning. I was all confused about how to integrate these experiences. It was a very dramatic experience, and lots of press, and I don't know.
Yeah.
It was a really life altering kind of experience to go through in many ways. And it made me question a lot of things. And and eventually, I decided that um, there's a place and an appropriateness for trying to beat the market, um, and that, but it's not appropriate for individual investors. And I think so. It wasn't that I decided to leave the hedge fund world, because I no longer believed that people could outperform the market, and we see, some great examples of investors that have beaten the market over time. But I felt that, but I felt that there was an opportunity to help individual investors to invest in a much more sensible, realistic manner that would allow individuals and families to build wealth over their lifetimes, and even potentially to help intergenerationally with their children and grandchildren and so on, by by just being a lot more just being a lot more thoughtful about how they do it, and kind of realizing that yes, there is alpha that's out there. People can beat the market, but individual investors, it might be too difficult for individual investors to really get a piece of that pie, and to get a
Yeah.
piece of that pie in a also in a tax efficient manner. So,
Hmm.
there might be alpha out there, it could well be, but I don't think that for most individual investors, it's sensible to be going after that. It's better to really focus on, participating in the long term growth of the stock market, of human flourishing, and so on, through diversified public market equities. That gives you most of what's available out there in terms of return, and just being really sensible about how much equities to own at different points in time. So that was
Yeah.
really sort of my journey. And yeah, I think I really changed my mind about a lot of things over that over those 10 years. Well, from the collapse of LTCM, over the next 10, 15 years, there were a lot of things where I changed my mind about them. And
Yeah.
I hope I'm still changing my mind all the time, in different ways. Yeah.
I mean, the good news is, Victor, we're in an industry where I mean, we're always learning. You've had some fantastic practical experiences along the way, but it's refreshing for someone like me to hear from you. Yes, I'm still learning at this point in my career, even with all these
Oh, for sure.
experiences.
Yeah, yeah,
So
yeah.
cheers to that, that we all continue to approach things as a student. I want to, I want to talk more about what you're doing with Elm Wealth. We'll get to that for sure later in the conversation. But one of the early examples you had in your book, which I think speaks to some of the experiences you touched on, this idea of bet sizing and over concentration. And there's a famous coin flipping experiment which you talk about and sort of outline how. I guess I'd love to hear how people tended to fare through this experiment. What did you learn from that coin flipping experiment? Can you just summarize that for all of us?
Sure. So I don't know exactly where the idea came from, but we did a coin flipping experiment. I don't know, 7, 8 years ago, I guess, where we gave people some real money and we let them bet on on a coin which we told them had a 60% chance of landing on heads, and they could keep their winnings at the end or however much money they had left from their starting point, and they could flip it a bunch of times. So we told them, and it did have a 60% chance of landing on heads. We weren't tricking them. It was 60% biased coin towards heads. And what we found, having lots and lots of people play this, is that players didn't really come to this game with any framework for what would be a sensible way to bet. I mean, there were some people that had maybe come across this. I mean, especially people that had spent time in the professional gambling world or trying to make money from gambling. They had come across, what do you call it? Bankroll management ideas around, like if you go to a casino, how should you manage, or how big
Yeah,
should you bet given a certain bankroll? But in general, people just came at it. Some people just bet the same amount. Some people like to double down. Some people just were pretty erratic, and there's a whole literature on sort of how you should size your bets when you know what your edge is.
yeah,
And very few people, and by the way, this was this wasn't like we went to Times Square and we asked people to play the game. We These were all graduate students in finance. Like that's really important to say. Sorry, they were graduate students in finance, or they were financial analysts working at prestigious financial firms. So
yeah,
these are people who kind of, quote unquote, should have known. And I'm not, uh, this is more about our education than it's the individuals. I mean, they should have known, but they weren't taught it. They weren't
yeah,
taught these ideas. And I was not taught these ideas either. I kind of wound up somewhat discovering them, and discovering them for myself over time. So it really kind of opened our eyes to the realization that bet sizing was not broadly appreciated. Of course, it was very well appreciated in certain quarters, and people had written about it. We didn't discover anything, or we didn't create anything. We just kind of recognized that, more people should be aware of this. It's important. This coin flipping experiment got a lot of attention. You can play it on our website even now. And we just felt that there was a job to be done to try to help people to understand the importance of this more.
yeah,
And that investing, we like to say that investing really is two decisions. You have to decide what you want to invest in, what's going to go up, what's going to go down. Like that's the selection decision. And then there's the sizing decision. Once you decide what you like and what you want, you answer the what question, then you have to answer the how much question.
yeah,
And if you get the how much question wrong, but the what question right, you can still go bust. I mean, I think that was the story of LTCM, that we had good investments. I don't think people looked at what we had and was like, oh, those were bad investments. And in fact, most of our investments worked out great over the couple of years after our collapse. So we got the what reasonably okay,
yeah,
but we had the how much wrong. So how much can make you go bust? Now, if you just continually get the what consistently wrong, eventually you're going to lose, most of your money. But if you get the what question wrong and the how much question right, you can keep going, and eventually, you kind of get there. I mean, eventually you have to get the what question right, but
yeah.
you certainly survive. You can survive a lot of getting the first one wrong if you get the second one right.
Mm,
Also, the what question is the most competitive problem in the world, that we're all fighting for what should we invest in? A
Yeah.
lot of it's zero sum. We're fighting against each other. It's the most competitive game in the world. The how much question is, how much is right for you? There's no competition. And it's so much easier. So we should always get the how much question right, because it's easier. It's not, if I'm right, you can be right too. The what question, kind of, if I'm right, somebody else has to be wrong. Uh, right? It's zero sum. The how much question is not really zero sum. We should all be thoughtful about it and kind of get it right.
Mm,
It's easier and it's not competitive. So, and that's really the whole investing, is just those two things.
yeah.
Um,
There's so many cool things to unpack there, Victor. And I think what's great about what you said is I feel like investors, particularly novice investors, overvalue the importance of getting the right thing, the what, and they undervalue the importance of bet sizing. It's almost like it's something you don't even think about, or if you do, it's like an afterthought. And I think the point that sort of drive home through the course of your book is how that is, I mean, arguably the answer. I mean, that's the thing you really want to struggle with. And I love, as you were talking about your the coin flip experience in your book, I think it was your mother was one of the people that was interviewed, and it was people that even understood. Like, I knew the odds were 60%, 40%, but even if they just tried to pick tails sometimes just to check that, right? And just
yeah,
to
she said,
feel
I
like it
couldn't
was
help
doing it.
myself. Yeah, I just couldn't
Yeah, I
help
couldn't help
myself.
myself. And so,
She
and
was
that
like, I knew it was going to be tails. I got 4 heads in a row. It was going to be tails. I couldn't help myself. Yeah.
I love that. I mean, that is, I think that's a way of thinking that so many of us, I'm sure, identify with as investors. So, if I could attempt to, or if you could attempt to connect what we just discussed to practical application, given the takeaways from that coin flip experience, where we're so just generally poor at appreciating the importance of bet sizing. How should investors generally be thinking about bet sizing? What are some of the broad tools and techniques we should be employing to make sure we answer that question a little better?
Sure. So, the really big question that we face as investors, the kind of the meta question, I think, is how much of my portfolio should I have in risky assets and how much should I have in safe assets?
Mm,
Now, of course, there's no such thing as totally safe assets, right? With a, that, but, but some assets are much safer than others. And, we generally feel that, stocks are risky, and government bonds are kind of the least risky things that we can get, and that we can have in our portfolio. And so there's this big question: how much stocks versus how much safe assets in bonds?
yep.
And that's arguably the most important decision we face as investors. Exactly which stocks we own, whether it's going to be broad-based index funds, whether it's going to be U.S. equities only, or U.S. and non-U.S. equities, or whether we're going to get into some private stuff or whatever. All of that is somewhat secondary to this big question of, should I have 75% in stocks, 90%, 50%, 40%? And there's, in our view, there's only one way that you can answer that question. And that is that you have to have a view of the expected return of that risky portfolio of stocks, or whatever your risky portfolio is, but let's call it stocks. What's the expected return? How much, hopefully in excess relative to safe assets, is that return? We could call that a risk premium, or the excess expected return. The higher that expected return is, the more we're going to want to own of those risky assets. We need to know the riskiness of the risky assets. The riskier they are, the less we want to own, and vice versa. And then we have to have a sense for our own tolerance for risk, or our own risk aversion, that we are
Mm,
naturally and rationally risk averse. It makes sense to be risk averse, that the more money we have, each extra dollar does less joy for us, or gives us less joy than,
mm,
and so since we have a decreasing marginal um, happiness or utility from each extra dollar, we're going to be risk averse, because, a 50-50 bet, it's like, okay, I'm going to be happier if I win, but if I lose the same amount of money, I'm going to be more unhappy than I was happy. I have a net expected happiness deficit from just taking a fair odds bet. So we
yeah.
need those three things. Now, when it comes to that, each one of those things is, might seem challenging, but they're not. We do have good long-term expected return estimates for stock returns. Um, we like to use the earnings yield of the market, cyclically adjusted earnings yield is that estimator. But you could
Yeah.
also just go around the internet. You could ask ChatGPT. I did that just recently. I said, what is the expected return of US equities over the next 10 years? And ChatGPT came back and said, well, there's a lot of things to consider, but Goldman Sachs says it's this, and PIMCO says it's this, and
Mm,
BlackRock says it's this, and Vanguard says it's this. So you could just, in 5 minutes, you could just go and say, ChatGPT, tell me, or any LLM, give me the expected return from 20 financial firms. And then you just could average them together, or you could do what we do and use earnings yield. So we have
mhm.
that riskiness. Like, we know when like early 2020 COVID, the market was very risky. There's no tremendous uncertainty. There's no question about that. Other times the market is very docile and peaceful. And so, I think assessing the riskiness of the market is relatively straightforward too, once we address it. And then your own personal degree of risk aversion is something that's introspective, something you have to think about. But there's lots of tools and thought experiments that will help you to think about it. And most people are falling, most people are falling within a reasonable range when they think about the kinds of bets that they're willing to take and what kind of compensation they need to take different kinds of big gambles. Now, some of this risk aversion assessment research that's been done out there is not very good, and it says to somebody like, okay, um, if you're going to flip a coin for $100, how much compensation do you need for that? And somebody says, I need a $2 expected return. And it's
Yeah.
like, then you extrapolate that out to a bet where you're going to lose 20% of your wealth, and it makes no sense. But I think there's really sensible ways, and we've done a lot of research in that area, and we find that people are like, more or less coming in within a certain range of risk aversion. Some people are a little more risk averse, some people are a little less, but it's not a tough one to tie down, and people are pretty comfortable tying it down themselves. So, in that sense, the coin flipping translates right into how much stock should I have. I'm
Right.
thinking about expected return, I'm thinking about risk, and I'm thinking about my personal risk aversion, in there. And the answer to the question of how much risk should I take, just, it's never as much as I can get. I think that's the thing. Like, you're never trying to maximize your expected return. You're always trying to maximize your expected risk adjusted return. The
Yeah.
more the more of a good thing you buy, the higher is your expected return, but the higher is the cost of risk associated with it. And we're trying to optimize that trade-off to find the amount of that thing to own that gives us the highest risk adjusted return.
Oh, that's so well said. And in my experience working for, large money managers, I found institutional investors tend to be way more focused on risk adjusted returns. That's a big part of how you think about, value at risk and just different ways of thinking about how much you're risking for this potential gain. Individuals, I found, tend to focus way more on the potential return, right? And not thinking about the risks associated. So I think you described that very, very well. Another one of the points you made in the book, Victor, I think really well, was talking about probably what I would call probabilistic thinking of just thinking about different probabilities. And a lot of what you are doing in thinking about expected returns is just for making expectations about what you think could happen. Can you talk about the importance of probabilistic thinking for investors and how investors could maybe upgrade their use of that in their own process?
Yeah, that's a great kind of central idea that we're talking about in the book, is that, since since we have this decreasing marginal happiness from more and more money, more wealth, um, it means that we can't just think about a central case. It makes that we can't think about the central case of outcomes of stock investing, of spending, of tax decisions, whatever.
Mm,
That we always have to be looking at the whole distribution of outcomes, and then translating that back through this objective function, or this thing that we're trying to maximize, of our happiness or welfare or utility. And there are just so many times when an analysis that's just looking at a central case leads you to a decision that really is suboptimal, not as suboptimal as what I was talking about earlier, where you lose all your money, but but really suboptimal.
Yeah.
And uh, and and uh, and so you really need to think about good outcomes, and then run that through your happiness calculator. Like, all right, well, how much happier am I going to be if I get a good outcome, and then the bad outcome, and a really bad outcome, and then weight those things together, because as I say, you can't just think about the expected outcome of the bet, or especially you can't really think about just the central case.
Yeah.
And right now we're doing some research that we're going to publish soon about like intergenerational thinking. And so we do this whole simulation, and we show that uh, that because uh, because the stock market has volatility, or because risky investment portfolios has all this volatility, good and bad outcomes, and because um, your family tree, if you have children, your family tree is going to evolve with a lot of uncertainty too. That when you put those two uncertainties together and start to think about, like, if you leave a certain amount of money for future generations of your family, that you can't just kind of take some central case and say, okay, the stock market's going to make 7% a year, and each one of my children is going to have two children, and each of their children will have two
Mm,
children. And if you do that and kind of just work through that central case, that takes you to some conclusions that, oh, this wealth is going to last a really long time. But if you put in all of that uncertainty over how many kids there's going to be, I mean, my kids could have 0, 1, 2, 3, even 4 kids, and their kids might also have a whole range of number of kids, and the stock market might be going up or down or whatever. And
yeah.
when you put all that together, you see that actually, for a certain amount of money that you're leaving for future generations, that there's lots of scenarios where it doesn't cover what you hope it would cover for them.
Sure. Sure.
And so, that's kind of and then you have to think about, okay, well, then I'm going to adjust my policy for how I want the future generations to spend the wealth, so that, it doesn't get hung up in some of these bad cases of bad returns and lots of kids, and it runs out of money, um, so yeah, so probabilistic thinking just comes in to all these financial decisions. I mean, there's this whole area, right, of decision making under uncertainty that
Yeah.
we've been thinking about for 300 years, and
Yeah.
it's a terrific area. And I wish our policymakers historically, like, I think some of the terrible wars that we've had in
Mm,
our history have come about because it wasn't probabilistic thinking, it was central case thinking. It's like,
yep.
this war, like, both sides are like, the most likely thing that's going to happen in this war is it's going to be over in a month and with virtually no casualties. Well, sure, maybe that was the central case, that the generals on both sides were saying, yeah, no, that the central case here is, 1 to 2 months, very few
Yeah.
casualties, and the whole thing will be over and we'll win.
Right.
but like, if there's like a 10% chance that the thing just becomes a disaster, like,
Yeah.
they needed to weight that in there, and they should have
Yes.
not gone in on the central case. They needed to think about how bad that bad case was going to be, and the bad case was going to be so terrible, that they
Yep.
should have not gone to war. And I
Yeah.
think there's many cases where that kind of analysis was totally lacking from the policymakers. They just said, this is all very complicated. What's the central case? It's
Yep.
like, no, you can't, that
Can't do
in,
it.
yeah, in
Oh,
decision
such
making
such a
uncertainty.
great
Yeah.
such a great analogy, Victor. I really appreciate that for sure. Speaking of decision making under uncertainty, I'd love to talk just briefly about the environment we find ourselves in here in 2025. Let's start with what you're doing at Elm Wealth. I mean, I always caution people. I mean, I've taught behavioral finance at the university level, and I always tell people, even though I've done that, that doesn't mean I'm not immune, and doesn't mean I'm immune to all the biases I'm about to tell you. Right? I still do silly things with my capital at times. You can trace it to these biases we all know very, very well. But given your experiences, given all the work that you've done academically, how do you translate that to what you're doing at Elm Wealth? I know you have an ETF as well, ticker ELM. Talk about a little bit about what you're doing today, and how these experiences, this work has, kind of informed your decision making in your portfolio now.
Sure. So, I mean, at a high level, what we do at Elm Wealth is we try to help investors to invest in portfolios of low cost, broad market ETFs, very low cost, like the average portfolio of ETFs that we will manage for clients, will be like a 6 basis point average expense ratio. So we're
Okay.
trying to, the goal is to help people to invest in sensible portfolios of ETFs. The next thing that we do is we try to make those portfolios appropriate for the expected return on offer in the different global equity markets,
Yeah.
the riskiness of the equity markets as it evolves through time, and to the extent that people have separately managed accounts that they want us to manage, also their personal level of risk aversion. We also
Hmm.
have some pooled vehicles where we can't individualize the portfolios to their risk levels, but we can kind of create a portfolio that's is a bit of a good one size fits all if we have to. It's a large size, I guess you would say. It's
Yeah.
probably, or maybe a medium size. And so what we're trying to do there, what we're trying to do in general also, right, is to make these portfolios appropriate. So we call it dynamic index investing, is what we call our approach to investing. We're using index funds, index ETFs. We're adjusting portfolios dynamically to be in line with risk and return. And it's quite resonant with most people. I think the objections or the criticisms of it is it's hard to do by yourself, and
Yeah.
that's true. It is, that for a do-it-yourself investor, it might make more sense to have a more static portfolio. But for many investors, they want to outsource anyway to somebody that will be very disciplined for them. So we kind of can help people to minimize those behavioral biases by ourselves doing things in a rules-based, disciplined way.
Hmm.
So for people that are looking for that, that's kind of perfect. And then, the other a challenge or a potential criticism is that dynamic index investing for taxable investors, if you're non-taxable in an IRA, you don't need to think about this. But for taxable investors, that sometimes we're going to be reducing allocations to equities, and that's going to generate capital gains. And so, isn't dynamic index investing less tax efficient than buy and hold? And in general, it is. We try to make dynamic index investing as tax efficient as possible by tax loss harvesting, by tax aware rebalancing,
Yeah.
et cetera. And so we can get close, but we can't get all the way to buy and hold, really. We get close. But the ETF that we have, ticker ELM, that ETF is able to actually be even more tax efficient. So that's like the ETF is this for people who are very tax sensitive, but they want dynamic index investing. The ETF, because of creations and redemptions and people coming in and going out and so on, we're able to manage it, and tax loss harvesting, et cetera, and tax awareness. We're able to manage that in a way where we can do the dynamic rebalancing without it creating a lot of tax realizations for holders of our ETF. So that's, for people that are really tax sensitive, that's good. For people that are tax sensitive but not super tax sensitive, our separately managed accounts can be really good also. But those are the problems that we're trying to solve for people: is do it for them, give them the discipline, keep them everything low cost. We charge 12 basis points for what we do. The
Yeah.
ETFs we invest in are about 6 basis points, so that's 18 basis points. It's not zero, but it's also not breaking the bank.
Sure.
And that's what those are the things that we can control: diversification, cost, tax, fees. And we try to really optimize those as much as we can for people.
No, that's well said, and I appreciate what you're doing for sure. One final question, Victor. I guess to wrap up today. I mean, one of the questions I get. I mean, my background is as a technical analyst, so I'm analyzing the markets visually, looking at statistical analysis and all that. And I'll give you a version of the question I've gotten a lot in a period here in a modern era of tariff tantrums and geopolitical uncertainty and military actions and policy decisions and an unpredictable Fed. It feels like all these great ideas about allocation and risk management are kind of totally out the window, right? How can we keep using techniques like that when one announcement can make the market go up or down 10%? How do you what's the argument for using these kind of tools and techniques in a period of severe market uncertainty? Or I guess the other way to ask that is, why are these relevant at a time when there's so much uncertainty and so much volatility?
Well, so the direct response is that what we're doing and what we think makes logical sense and sort of is consistent with theory is that when you're in an environment where the market is very volatile and where there's tremendous uncertainty, that's the time that you should have less exposure to those risky assets, because you want to kind of manage your, one way to think about it is you're managing your risk over time. So when markets are very volatile and there's a lot of fundamental and other uncertainties out there, then you reduce exposures. And when markets are really quiet, you run larger exposures, and you're always ready to switch between those two states. So first, I just totally agree with you that that risk is one of the there's return and there's risk. That you can't just look at return and say, oh, return is high, and that's all I care about. You have to look at the risk, and you have to really, like in our case, that just based on risk alone, an investor, let's say we have an investor that wants to be 60% in equities in general. Well, we would run equity risk of 40%, all else equal, based on a high risk environment,
Yeah.
and equity exposure of 80% in a low risk environment. So double the amount of exposure in a low risk versus high risk environment. So risk is totally agree with you on that. Sometimes the risk is latent, right? Like right now,
Mm,
I mean, I think that's a tough one. So right now we are back in, I think that we are back in a low risk environment right now in terms of market behavior. The
yeah.
market is just not moving right now. Implied volatility is low, realized volatility is low. There's just nothing going on. And
Yes.
yet, all the things that you said are there, latent, and so, one thing investors could do is they could be thinking, they could be coming up with their, it's difficult, you could come up with like what your assessment of the latent, of the policy uncertainty is and all of that. You could
Yeah.
do that. I think it's hard. It's easier to just look at the market, and when the market is swinging around, call that high risk, and when the market is quiet, call it low risk, and just be ready to move. You just be ready to switch from
Mm,
one to the other when it changes.
yeah.
But I think right now is this weird environment where things just feel so uncertain. What's
Yeah.
going to happen with these tariffs? Isn't the economy falling off a cliff, or is it not? Is what's politically happening? Are we about to see a Fed chairman get fired?
Yeah.
I mean, all these things,
Yeah.
tremendous uncertainty, but the market is just like, okay, everything's kind of cool right now. So I think that's a tough one. Then when it comes to long-term expected returns, that we haven't seen anything that's better than using earnings yield to think about the next 20 or 30 years of returns of equity markets. I think the AI thing or whatever, like, I just don't think that historically we've ever seen technologies that have massively changed the trajectory of corporate earnings over the long term.
Yeah.
And because we live in a competitive, I mean, the one explanation for that is we live in a competitive world. And so we can see right now all these companies are spending a ton of money trying to generate AGI, trying to get to that next step of AGI. Everybody's trying to incorporate existing LLMs into their business. And it's not like there's just free money, that first it takes investment, and then second there's competition. So
Yeah.
yes, will AI lead to greater productivity growth? Yes, it should. Will that lead to some decoupling of corporate earnings from the economy? I doubt it. History
Yeah.
tells us probably not. We've had big productivity surges in the past that are not reflected in corporate earnings going crazy. So I think that earnings yield is still okay. I think those things work for thinking about the long-term future, but I think risk is such an important thing, and we've got to adjust ourselves between those environments. I think it's really that's probably that probably has been the most beneficial thing you could have done over the last 125 years is, when you're in a high risk environment, cut risk; when you're in a low risk environment, increase risk, or, which is basically following a momentum strategy, right? That
Yeah.
when
Yeah.
that when markets are risky, momentum tends to be negative. Price momentum tends to be negative, and
Yeah.
when, and vice versa. So using momentum as a proxy for risk has probably been the single best investment idea well, not over the last 125 years. I bet it's the single best investment idea since for the last 400 years, I bet.
Yeah, right, right. No, there's so many great points in there, Victor. I really appreciate your take there, and it is an unusual feature of 2025 where, as you described, the latent risk, right? All these things that you feel like should be injecting a ton of volatility really are not, right? The VIX is consistently below 20, kind of a low volatility environment. So there's this mismatch there, but I mean,
It's coming.
more.
It's coming, right? Well, we're
I was
gonna,
going to say,
right. Well, the market is going. I mean, whatever. No matter what, no matter what we think of what's happening today, we will be in a high volatility environment before long. I mean, that's just the nature of markets, right? That's coming. We don't know if it's going to come for the reasons we think, but it's always around the corner.
No, I feel like by the time this podcast episode gets out, maybe volatility is completely. I mean, who knows, right? But
Yeah,
to your
yeah.
point, I think that's great advice to focus on risk now more than ever. Think about those potential outcomes, and have be thoughtful about potential returns versus potential risks. Victor, this has been such a pleasure. I really have enjoyed meeting you. I mean, you come across as a genuine, humble, intelligent person in your book, and in real life, you seem to be that as well. The book's called "The Missing Billionaires: A Guide to Better Financial Decisions." I enjoyed it greatly. We'll make sure we include a link so
Oh,
people
thanks so much,
can check
Dave.
it out. Where can people find out more about Elm Wealth and what you guys are doing there?
I think the two main places are elmwealth.com, which is our financial advisory business where we try to help
Okay.
people more with separately managed accounts. Our ETF's website is elmfunds.com.
Okay.
And, I'm pretty active on LinkedIn, also getting going on X. I don't know if we have 10,000, but we don't say, I mean, we try to keep people apprised of our thinking, of our research. So, we're not like getting into discussions much on X, but we just remind people that, oh, we just published our capital market assumptions, or we're talking about intergenerational things. And then it just reminds people that don't necessarily want to be on our mailing list. It reminds people, oh, maybe you want to go to our website and read our latest research or this or that. But
Yeah.
so those are the different places. But mostly I would say, our website, you can sign up, you can subscribe there for our free research and kind of join our community there. And I mean, I think just like you, Dave, and we're trying to help people to make better financial decisions. And if we can help them directly, that's great. If we can help people just through sharing ideas, that's great too. We're happy. That's our space.
Yeah. No, Victor, I really enjoyed our conversation today. I hope we can continue this another time. I'd love to dig deeper into some of these, but for now, I'll say thanks so much for giving us some time today.
Thank you, Dave. Really enjoyed that. Thank you.
Victor was just awesome. I hope you enjoyed that conversation. It was a real pleasure to get to know him a little bit. I'd read his book and really enjoyed it, and appreciated the opportunity to talk through some of the key points with Victor. He agreed to come back on the podcast down the road, so I hope we're able to circle back and dig deeper into some of these particular themes. We only talked about the current markets a little bit at the end, so hopefully we can talk a little bit more about some of the things they're seeing as they try to manage potential returns and potential risks. But again, one key takeaway, which I hopefully was effectively focused on in our conversation, the importance of bet sizing. As Victor and I talked about, I find so many novice investors, particularly using technical analysis, focus so much of their time on picking the next home run, right? They want to be the next Peter Lynch, the next Warren Buffett, the next whatever hedge fund manager you want to throw in who sort of found an amazing thing and was able to identify the next big thing before it was the next big thing. We focus way too much of our attention on that and nowhere near enough attention on bet sizing, on how much risk we're allocating, how much of our portfolio we're allocating to different things. Victor talked about when to increase or decrease risk in your portfolio based on the risk in the markets, right? The volatility in there as assets are moving naturally. And I think there's so much to dig into with that particular line of thinking, but I hope you appreciated the importance of bet sizing. Reflect on some of the ways you can improve on that process in your own portfolio. By the way, if you want to learn more about some of the tools and techniques that technical-oriented investors make to make better decisions about allocation and bet sizing and risk versus return, our Market Misbehavior Premium memberships may be a great way for you to upgrade your own decision-making in 2025 and beyond. 3 great benefits to the Market Misbehavior Premium membership. First off, you'll have access to all of our virtual courses. We'll start you off with Flight School Behavioral Investing, where we'll talk about behavioral biases. We'll talk about technical analysis as a practical set of tools to understand and analyze the world around us as investors. Second benefit, you will have custom or members-only reports like our weekly flight plan, our main report that we put out every weekend, where we focus on what we learned in the week that just happened. We look forward at the week to come, what levels, patterns, signals are we on the lookout for. Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our members-only community. You'll be able to invest alongside a series of other like-minded investors, trying to analyze the markets, trying to make better decisions, helping each other, encouraging each other as we do so. A lot of great questions in there every trading day. I'm in there every morning answering questions from our premium members on particular charts, on particular technical approaches, on macro versus micro themes, and everything in between. You'll have access to all of that and more as a Market Misbehavior Premium member. You can learn more at marketmisbehavior.com/premium. Make sure you use the code PODCAST when you check out for 30% off your first 12 months on any plan. That'll do it for today's episode of the Market Misbehavior Podcast. Thank you so much for joining me. My name is Dave Keller, here to remind you it's always a good time to own good charts.